DraftKings stock has been on an absolute tear over the last little over a year. The stock is up more than 4x since the start of 2023. Hard to argue with the company's improving financials, increased number of users, also increased spending per user. But the question for investors right now is this a stock that's worth buying at a $23 billion market cap in a company that's still losing money? I think there's fundamentally a lot of structural challenges with the online gaming business. There's not really any lock-in. People can move from app to app depending on what they want to do. And fundamentally, your customers are the people that you are asking to lose money gambling quarter after quarter after quarter. So I want to go through some of the numbers and why they might not be all that sustainable, at least in a positive direction. The theory long-term is that DraftKings is going to be able to contain its operating costs and be able to increase the number of users, the spending per user. But I think there's a lot of questions behind that as the company continues to spend hundreds of millions of dollars advertising on podcasts, on TV, all to just attract more customers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So I want to start with a couple of charts that really show the improvement at DraftKings recently. The first one is the user numbers. And this is what I was talking about earlier. This is the number of users in orange, monthly unique players. And that's gone from about $900,000 prior to the pandemic to 2.7 million recently. So up about 3x over that period of time. That's really solid growth, but that's compounded with the growth of spending per user. And this is on a quarterly basis, but the average user is now spending $113 or losing $113, generating that much revenue for DraftKings. So you're talking about a very significant amount of money that people are losing betting on online sports and other gambling that the company has. Now, this is what has driven DraftKings revenue growth, which you can see here. Since 2017, compound annual growth rate of 63%, and just continues to grow at a really rapid rate. But there are a couple of things that we need to think about with DraftKings in driving that revenue growth, and that is how much it costs to generate that revenue. In orange, that was $2.3 billion in the most recent year. And the other thing is selling, general, and administrative. So this is going to be the marketing costs that go into attracting customers to DraftKings. In the most recent year, that was $1.8 billion. That was actually down slightly from 2022. And that's resulted in operating losses declining by about 50% over the past 2 years. So if you're pointing to the improvement in DraftKings business over the past couple of years, it's really because these trends are starting to move in the right direction. But I think the fundamental question that we need to ask is, how big of a market can the company reach, and how much can they get each one of these gamblers to spend and lose on the platform on an ongoing basis? Remember, this isn't recurring revenue. This is bets that people have to go in and place game after game after game. And so if you're losing $100, $200 a month, you really got to question how long that is a sustainable business model for DraftKings. Now, the other thing is that the spending on SG&A, marketing expenses, is only going up over time. DraftKings, like a lot of other competitors like FanDuel, are starting to advertise more and more on television, are going to be integrated with some of the streaming apps. And you're talking about bills that are going to be north of $1 billion on an annual basis. I mean, if you listen to any podcasts or even watch YouTube videos, there is a ton of gambling advertising, and that's spending that they have to do on an ongoing basis to attract new customers. So that's really where you have to think about what the payoff is for this company. And right now, we don't see a lot of payoff in the financial results. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There are a number of ways to judge DraftKings investments and how much those are paying off. One would be net income, and you can see here, net income has just been absolutely abysmal, lost $802 million in 2023. The other thing would be to look at free cash flow. And here you can see there's been a sharp improvement in 2023, and the company has even swung to positive free cash flow over the last couple of quarters. But again, we have to wonder how sustainable that is going to be long term. A couple of the drivers of the growth for DraftKings over the past few years has been an increased number of states where gambling is legal, and then obviously a growth in the number of users based on the advertising that has been taking place. But how much of that is going to be recurring long term and how many more states are going to be added? I think that's where you get to really questionable numbers from a growth perspective, because it doesn't seem that gambling is going to be added in a lot more states like it was during the pandemic. You remember there was that period of time when a lot of states were looking for sources of revenue. So gambling was a natural way to do that. And online gaming was something that didn't have to approve casinos. It was sort of hidden in the background. So it was a nice new revenue source for states and didn't really take a lot of effort to launch that. And so DraftKings was able to expand and grow the user base on the back of that expansion across the country. And that's something that they've worked on for a number of years. But now the growth drivers are going to be the spending per user and how many new users the company is going to be able to attract on an ongoing basis. Here's what I'm talking about with the scale that the company's already reached. As of the end of the year, the company had reached 46% of the US population and about 40% of Canada's population with its current offerings. That is primarily the sportsbook, but now iGaming is available in 5 states as well. So the fuel behind the business from just expanding the number of geographies is going to decline over the next few years. And that's going to likely mean that there's going to be more competition for the existing customers in the market. I don't think it's likely that we're going to have millions of new users who are completely unfamiliar with online gaming or online sportsbooks. So now companies are going to try to steal them away from other competitors. If you're FanDuel, you want to get DraftKings customers. Same thing with BetMGM. So this is what I think is going to likely limit the profitability of these companies long term. And we can already see that in the numbers. Despite all the growth in revenue and the user base, the cash from operations is only positive over the last couple of quarters. That is obviously a nice improvement for the business. But again, you're talking about hundreds of millions of dollars being invested to acquire these customers. And the theory is that they're going to pay off over the long term. This is what they call cohorts. So you spend a bunch of money to acquire a customer, maybe $200, $300, $400 in incentives, in marketing spending, and then you hope that they're going to pay off by spending hundreds of dollars per quarter on the DraftKings platform, and they end up being profitable customer long term. Now, we don't have a lot of evidence behind what that ultimately looks like, but the profitability of the business has not indicated that those investments are paying off quite yet. So where should investors be looking to profit from this general trend? I think the much better way to make money off of the growth in sports gaming is going to be from the companies who are getting paid that advertising revenue. So companies like Disney. Disney has not only ESPN, which is directly getting money from Penn National with their deal that they recently signed with them, but they're getting advertising money for the commercials that companies like DraftKings and FanDuel are running. They're also playing the actual games. So customers who are going to be betting on a lot of these sports are going to be subscribing to ESPN's products and Disney's bundle of products potentially, and probably spending even more and more on those as a lot of those products go over the top on the sports side. The other company to think about would be Spotify. Spotify is providing the advertising platform for a lot of these companies to reach customers in the gambling space. So these would be much lower risk ways to benefit from online gaming, and you get the benefit of not having to take the risks of a business like DraftKings, which hasn't proven to be profitable long term. It's very possible that this does become a profitable company, but like I said, the valuation at a $22 billion market cap means that investors are expecting this is a company that can generate $1, $2, $3 billion in annual net income. I just don't see a path to that right now. It is a very volatile business. Operations have been improving, but given that tremendous amount of spending that it takes and all the commercials that you likely see when you're watching sports, if you're listening to a sports related podcast, that is all money that's going from DraftKings to their partners. So as an investor, I want to be investing in the companies that are offering that advertising platform. So I think Disney, Spotify are going to be two of the best ways to play that, and a much lower risk bet than DraftKings. But what do you think about DraftKings' future? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.